So let me tell you a little bit about the buyers of the business. Broadly speaking, there are three types of buyers, and it really depends upon who you are as a company and what value you have. You need to think very hard about whether your value is financial value, in other words, you're making lots of money and people will buy you because you're making lots of money, or whether you have strategic value because you have a good position in a market which is of interest to other potential buyers. Once you figure that out, then your buyers will either be strategic investors or financial investors, or they might be somewhere in between. We call them hybrid investors. So I'll go through them one by one. Strategic investors are corporate investors. These are other companies. They are very different from financial investors. Corporate investors are buying you because they see synergies with you. They see, for strategic reasons, they think you're strategically attractive. Maybe your know-how, maybe your technology, maybe your customer base, maybe your market position, maybe your value chain, or where you sit in the supply chain. So they will be interested in merging with you or taking you over and taking advantage of that strategic value which they see in you. These are long-term investors, so they'll be with you forever. Strategic investors don't buy and then try and sell you after 3 or 4 years. They will typically try and buy you and then consolidate you into their existing business. And the people we deal with on our platform, they could be global investors like Japanese, Korean, Chinese, Taiwanese. They could be local investors, Singaporean, or they could be Southeast Asian investors if you like your business model, want to bring it into another market, for example. They could be competitors of yours. Maybe you have a number 3 company and you're the number 2 or you're the number 4. They'll want to consolidate with you. They could be a supplier of yours. If you look at your supply chain management or your value chain, very often buyers are in your value chain. So think who's supplying to you or think who you're selling to. These are quite often good potential strategic partners for you going forward. So that's on the strategic investor side. They are, some pay good money. Some people actually value you more because they see more strategic value. Some of them themselves are not very highly valued because they are listed on the stock market and they're trading at some low valuation, and then they'll say, well, I'm not going to buy you at a higher valuation, my valuation, because then it's diluted. So they're a little bit difficult to deal with. They're not professional investors. But I think they are, probably the most important type of investor for you, unless you're a decent size, which goes on to the next one, which is the financial investors. Financial investors are purely there to make money off you. I used to work in Carlyle Group, which is a big private equity fund, and our job was basically to buy businesses cheap and then sell them expensive, and then we take the profit, and over 4 or 5 years we'll grow the business and then we'll sell at some big price, and private equity funds basically take 20% of the profit, which is the value which they make. So financial investors are not your friends, they are basically your financial partners. They will be there for a short period of time, maybe 3 years or 4 years. They will work with you to try and grow the business, increase the value of your business, and then eventually they'll want to sell at a good price. And if you still have shares in the business, then you'll also make money as well. So I would say that financial investors, not everybody will like to sell to financial investors because they're a little bit mercenary. But for certain situations, a financial investor is very good. Let's say, for example, you are a business which has significant growth potential, but you are not an expert in finance. You are an operations guy. But if you work with a financial investor, they could give you capital, they could give you know-how in terms of growing businesses, they could give you, they could help you exit your business at a very high price in the next 3 or 4 years. So they might say, look, we'll buy your business, we'll buy 75% of your business, you keep 25% of your business, and we'll all work together to maximize your value in the next few years. Or they might say, look, we'll just invest 25% of your business, we'll give you some money now, you can expand into all these other markets, and then together we'll try and grow your business over the next few years and then will exit in a few years' time. So that's basically how a financial investor thinks. They're very smart. They don't pay. Don't forget they're trying to make money. So if you're in a very sexy space, they might pay aggressively. But if you're not in a very sexy space, one of the ways they make money is to buy fairly cheaply, because that's how they can make the profit. So, of course, it's up to the negotiations, but that's basically how financial investors work. And you have private equity funds. These are guys who typically take a majority stake in the business. They'll want to buy your business 100% or 90% or 70%, and then work with you to grow the business. Then you have growth capital funds. These are private equity funds that are looking to take a minority investment. Typically, if you need additional capital to grow in different markets, say you want to build a factory or you want to go into different countries, they'll give you some money in exchange for new shares in the company, and then they'll help you grow the business going forward. And then we also have some late-stage VCs. This is more for the tech companies amongst you. Some of the VCs now are moving a little bit later stage. And there's some specialist funds as well. If you're specifically in AI or in some technology or in F&B or in semiconductors, then there are actually financial investors who specialize in your particular sector, and they will know a lot about your business. So it's definitely worth speaking to those specialist investors as well. And then finally, we have some hybrid investors, and these are kind of in between. They are financial sometimes, but they're also strategic. So a family office is a good example of that. Family office is typically a wealthy family who run their own money. Sometimes they want to buy businesses, or sometimes they just want to be more of a financial investor. Some family offices have made money in fashion or in food and beverage, and they're looking to acquire similar businesses. Other family offices are just looking specifically to invest in venture capital or private equity. And there are also some funds called search funds, and I see a couple of friends in the audience who actually belong to the search funds. If you have a chance, please raise your hand if you're from a search fund. There you are, that gentleman in the back. He is, afterwards he can explain what he does, but basically these guys are very smart entrepreneurs who have run businesses in the past, and they're looking to help SMEs with their succession planning. And they are basically saying, look, you want to retire, I'm looking for a good business to take over. Rather than building up myself, why don't we come to some agreement? I'll take it over from you. We'll come to some agreement in terms of price and negotiations on earn out, etc. And then we'll both create a win-win situation.